Now that we've completed our 5-year unlevered free cash flow forecast, we're ready to begin building our discounted cash flow model. We'll do this from the ground up, so here we have a blank tab. All we've done is added a header and called this tab Calculation of Enterprise Value. So our ultimate goal for this worksheet is to calculate the enterprise value of the target business, based on our estimations of the potential future cash flows under our management. To do that, we'll need to calculate the present value of the future free cash flows, along with the present value of a terminal amount we determine for the business. So let's first add a section to this worksheet to hold our discounted cash flow analysis. And we'll give this 2 headers. The first will be for the period, and the second for the year. For the period, the first column is simply the first period, and then we'll add 1 beginning in the second column until we get to 5 periods. Then for the year, we'll link this back to an input on the About tab. And again, we can simply add 1 for each successive year after that. Then we'll leave 1 column blank, and then the final column will be to calculate our terminal value. So we'll name the year terminal. And then here we'll also add the period 5, because we'll be calculating a terminal value as of the end of the 5th period, which will then discount like all other cash flows. Don't worry too much about this right now, we'll come back to this in a few episodes. Then let's just add some quick formatting. We'll give these 2 header rows a bottom border, and we'll separate our annual cash flows from the terminal value as well. Then the first thing we'll do in our discounted cash flow analysis is just add a quick summary of our cash flows. We could simply pull in the total unlevered free cash flow, but I think it's a better presentation to provide some context for that. So the steps will be the same as on our free cash flow forecast. We'll begin at net income, add back our interest, that gives us our earning before interest and taxes. Then we'll first list the non-cash expenses we add back, which for us is only the depreciation. And then we'll subtract the items to get to our unlevered free cash flow. We have 3 of those: taxes, annual capital expenditures, and increases in the amount of capital tied up in working capital. Then we'll format this just to make it a little bit easier to read. So let's bold our net income here. Indent the interest. We'll bold our earnings before interest and taxes as well, and then let's give this a top and bottom border. Then we'll indent all of these items we add and subtract, and indent the items themselves 1 more. Then we can grab all this information right off the 5-year cash flow forecast we walked through last episode. So our net income is line 83 here. The interest we'll be adding back is line 85. We can sum these up to get our earnings before interest and taxes. Depreciation can be found here in line 93. Taxes we'll have to calculate, so we'll calculate this just as our tax rate multiplied by our earnings before interest and tax. CapEx we can find here in line 96. And changes in working capital, line 97. Then we'll need a total line here for our unlevered free cash flow, which we'll highlight green just to make it visually easy to see that this is a total row. We'll bold it as well and give it a top border. Then we should be able to sum this up as simply our earnings before interest and tax, plus all of our adjustments. And we can now copy our formulas over to period 5. And there we have our unlevered free cash flow for periods 1 to 5. Like I said, we could have just pulled that in directly off the free cash flow forecast, but for our presentation here, I think it's nice to have a little bit more context. Now the next step will be to discount those cash flows to the present day. And recall that to do that, we divide by 1 plus the interest rate raised to the power of the number of periods in the future the cash flow occurs. So let's create a discount factor line where we calculate that amount, and then we'll also add a discounted cash flow where we'll calculate the actual present value of our cash flow. We'll highlight these 2 in green as well, give them a top border, And just clean up some formatting a little bit. We'll bold our discounted cash flow amount. So for now, let's just assume our interest rate is 10%. We'll have to go about calculating our weighted average cost of capital in a bit, but if we just assume 10% for now, we'd calculate our factors in this line with the formula 1 divided by 1 plus 10% raised to the power of the period we're in. And then we can calculate the present value of our cash flow by multiplying our nominal unlevered free cash flow by that discount factor. And we can then copy that over to period 5. But in our analysis, we can't simply hard code 10% like this. The interest rate we're using is extremely important. Whatever we determine here will have a significant impact on the results of our analysis. And that brings us to the title of the episode. Exactly what discount rate should we use? Well, this will depend on the types of cash flows we're discounting. For instance, if we were accounting for a lease under ASC 842, which requires us to determine the present value of our future lease payments, we would use either the rate implicit in the lease or something called our incremental borrowing rate. Or a different example, if we were trying to determine the amount to pay for a bond we were planning to purchase, the discount rate we'd want to use is the return we require on the investment. We looked at an example of pricing a bond like that earlier in the series. But in our example here, we're looking to determine the enterprise value of an operating business. And any business is funded by some combination of debt and equity capital sitting on the balance sheet. Those are really the only two categories. Every dollar of capital funding the business is either borrowed from a lender or belongs to the equity holders, whether that equity was originally contributed by investors or built up over time through retained earnings. And both of those forms of capital will come with a cost. Debt holders require interest to be paid, and equity holders will require a certain return on their equity stake in the business. So ultimately what we're trying to determine is the cost of our capital to finance this business. In finance terms, this is known as the business's weighted average cost of capital, often shortened to WACC. And on the surface, this isn't an overly complex figure. We call it the weighted average cost of capital because it's made up of exactly that, the weighted average of the cost of our debt capital and the cost of our equity capital. And it's this weighted average cost of capital that we'll use as the discount rate in our analysis. This ensures that the required return of our capital providers, given the risk of this business, is reflected in our discount rate. Now, one important note here is that the proper weighted average cost of capital to use is based on the long-term capital structure we plan to implement at the target company under our management. We're assuming that we plan to keep Evergreen functioning as a separate operating entity, but it will be up to the parent entity to determine the capital makeup of the balance sheet. So if our capital plan is for 60% debt and 40% equity, our weighted average cost of capital will be 60% multiplied by the cost of our debt plus 40% multiplied by the cost of our equity. But if instead we plan to hold very little debt on Evergreen's balance sheet, say our planned capital structure was 10% debt and 90% equity, we'd calculate our weighted average cost of capital as 10% multiplied by the cost of our debt plus 90% multiplied by the cost of our equity. And one more important note. Our discount rate when determining the enterprise value of Evergreen's operations is based on the long-term capital structure we plan to implement at Evergreen. It's not based on the mix of debt or equity we may use to finance the purchase of the shares of Evergreen from the current owners. That's relevant in a separate analysis of our expected returns, and we will touch on it, but it's not the figure we'd use in our calculation here of enterprise value. So I don't want to get too lost in the weeds on the corporate finance topics of capital structure and strategy. What we're focused on is the application of time value of money concepts to perform a discounted cash flow analysis. But the cost of our debt and cost of our equity do overlap significantly with our previous discussion about how, in essence, The interest rates we use in time value of money problems represent risk. So we'll spend a couple episodes here discussing how to go about calculating the weighted average cost of capital for our analysis, and call back to those concepts of risk and opportunity cost we've learned about previously. As we've learned, our weighted average cost of capital is made up of two weighted items, the cost of our debt and the cost of our equity. So let's spend a little bit of time on each, beginning in the next episode with our cost of debt.